QQQI, an ETF, the Powerhouse Income Fund. Should we drip or not to drip in retirement? This is the big question. And also, is this a fund that you should have in your retirement account? So what makes QQQI unique? Well, QQQI combines the NASDAQ exposure with a covered call option strategy to generate consistent monthly yields. The core strategy is an actively managed ETF with a dual approach. It maintains exposure to the NASDAQ 100 and generates a tax-aware option overlay strategy. The option strategy with QQQI does not write 100% of the portfolio in covered calls. The option strikes and the expirations are actively selected, and the goal is income without fully capping the upside. This is what makes it a little more aggressive than other NASDAQ 100 ETFs. What it allows it to do is capture option premiums, retain a partial participation during market rallies, and adjusted exposure based on volatility conditions. In short, this is a flexible covered call strategy, not a rigid covered call strategy. This is what makes QQI so unique up against other players. Now, I do have to say past performances do not guarantee future results, and the information in this video is for educational purposes only. I am not a licensed financial advisor. I pretty much do this. As you know, if you've watched my channel, I retired early. I've been retired for over 10 years, and I study stocks on a regular basis. I've studied how to retire in a long time. So if you need financial information, always contact a financial advisor or a professional before making those decisions. So this performance of this fund, QQI launched January 30th of 2024. So we will almost close out 2 full years here in matter of days. Now the performance of the fund is about 8% increase over the past 24 months. Now would that make anybody really excited? The answer is probably not. But remember, this fund wasn't designed for that. It was designed to generate income. The distribution history. The monthly average is about 62 cents per share or $7.44 per share over the past 12 months. You look at it currently, the past 1 year, the past year, it's only up 0.79%. Now you got to remember, we had that huge drop off in April, which cleaned out a lot of the asset or a lot of the value that we had originally. It recovered tremendously well back up to its normal levels. The performance, though, over the past year, 16.28%. Now that means basically we're looking at big yields, and since inception, 19.95%. Now, what's really adding to this is a 0.66 1 month and a 1.22% year to date, which we're basically, 24 days into the month. So you have some still showing some solid income with some growth across the board. Now, the growth, we said 0.79% over the past year. So that means distribution yield is about 13.884. Your total return, it gives you a 16.28%. So I remember on this channel, we are always concerned about total returns. How does the total return break down? How much of it is growth? How much is it yield? So we take a look at with 13% yield and total return of about 16.28%, $8.414 billion in assets under management. So this thing has a ton of money to work with to help continue. 0.68%, which is fairly low for a managed ETF fund. We take a look at 154 million shares outstanding. We talked about the dividend of $7.46. It pays it out monthly. And like I said, January 30th was the inception date of 2024. The 52-week high, $55.93. the 52-week low, $41.17. So we're at the higher end right now of the price, but as you can see, it's been holding its own. So what we do here is we're showing you a 100% drip strategy over the past 12 months. Now, the initial starting investment could have been any number any number at all. We just always like to use about $500,000 into a fund. So we would have been able to buy 9,326 shares, or at the basic January price of $53.61. Now, every single distribution that we would have received, we would have taken that and turned it right back into reinvesting more shares. Ultimately, in 12 months, we would have been able to collect 1,425 additional shares. When we did that, that's about 100 to 110 shares per month added back into the program. The portfolio would have grew at 15.65% despite share price declines or anything else. Our portfolio grew. So from $500,000, we're just a hair under $600,000 over that past 12 months. We're basically getting a $6,189 monthly in distributions. Okay, the pot, like I said, grew at 15.65. Distributions actually were reaching $6,800 near the end, keeping the growing over the last couple years of the fund. This is going to looks like it's going to continue to pay the distributions and continue to grow that if you keep pouring the 100% drip into it. That average, like I said, is $6,189. So this is a way of doing it if you have no desire, no need for that income, that you want to just keep your fund growing over time. So you could back this thing up, and if you're 10 years away, 20 years away from retirement, you need to slowly grow a fund. This is one that's designed that you can just drip the product into it. Now, personally, I think there's other funds bigger and better for this type of operation. But again, showing you what you could do in this type of application. Then we turned around and said, well, okay, let's do a little different. What happens if I'm starting into retirement, or I'm into a certain where I need income, but I don't need a lot of income? So what I said is, let's try a balanced approach. We do a 50% drip strategy. Now, at 50% strategy, was really unique because the total income that we came out with would have been $37,116, or basically $3,093 a month, which is about 7.42% income from your initial $500,000 investment. The portfolio would have grown at 8.5% because the other 50%, the other $37,116, would have been back into buying additional shares. So you would have been buying about 712 shares over the past 12 months, and with historically maintaining a similar portfolio balance over the observed period, you would have generated a total of $74,233. 37 of it goes into your pocket, 37 went back into your portfolio. Then the big one here, which is the one I do with personally when I do own this fund, I do it this way. I do a zero drip strategy because I want the income. And here's the unique piece to it. I want the income in my pocket. And then if I want to make a decision to put money back into QQQI, I can. If I want to start a different fund, an S&P 500 fund, a Russell 2000 fund, or I just want to take and put the money somewhere else in the marketplace, I have the ability versus always dripping into this fund, because this fund is designed for income. You've seen it already. The growth has not been huge. It's about generating income, building off of those tax rewards, which we'll talk about, building off of taxes, building off of different pieces to help me in retirement. So if I took this $500,000 and put it into the fund, I would have about $69,417 per year coming in. That's an average about $5,784 a month. Now, my portfolio would have basically grown 1.50%. So the increased value of another $7,500 of natural growth would have changed my portfolio a little bit. So if I'm taking a monthly $5,784 off of the table, putting in my pocket, spending, paying my bills, doing everything I need to do, plus, is that big enough money? That's different from everybody's answer. Is that big enough to retire off of? It's different from everybody, but that's a huge number coming in on a monthly basis. And what happened to my fund? It stayed solid. It stayed same. It grew by 1.5%. Now, is that big enough to cover the inflationary things that we're talking about? Not really. And that's one big concern to take into place. But you look at the distribution history, and that's the one thing I look at. The distribution history, other than April distribution, everything was pretty much on a steady, slow grind moving forward, moving up. So I could really establish bills based off of these type of strategies and off of this type of an income with one little dip into April. But across the board, it's again a fairly potential for that fairly smooth, aggressive move forward. So high income, low growth is what this fund really is designed to do. It takes full distributions, leads to similar, smaller portfolio growth. No big wheels, no big windfalls. It's a steady income, as I just talked about, income versus principal. And the risk return, with zero drip offers a higher income, but no monthly return. But again, that's how you use it. You have the option to do what you want to do with it. So now we're going to take a look at the growth of the portfolio comparison. If you're doing 100% drip, you're looking at about 15.65% because you have majority of your income going right back into it across the board. 50% drip, you're at 8.36, and zero drip, your fund grew at 1.50. So very critical of exactly, as I said, this fund is designed for income. This is not designed for growth other than 100% dripping it out at 15.65%. Using a 50-50, taking some money off is going to give you an 8% growth. A nice number, but I would rather see you do a different fund if you're looking for a mixed blend or across the board. Always use the QQQI. Think of it as my income generator, not a growth piece. Now, here's why. The big question out there. This is the reason what is going on. And it's the tax efficiency of the NEOS packages. SPYI has it. QQQI does this. It's the tax efficiency of the Section 1256 benefits. QQQI's tax advantages enhances the tax returns through that Section 1256 contract treatment. So the option contracts qualify as the 1256 contracts, which means 60% long-term capital gains and 40% short-term. Now they're taxed at regardless of the holding period. So the advantages for the higher tax bracket investors, this is a huge piece. Now they also use, and we did not cover this, and this is always why I say you always talk to a tax professional or a CPA or investment licensed professional, because this one also uses some ROC, which is return of capital, part of their tax treatment. The traditional income ETFs, which normally give you ordinary income and standard capital gains rates, would apply, and it's less tax efficiency. So realistically, QQI tax break is at 60-40. So definitely a big thing, and that's one of the things that NEOS brings to the table. Now, the real world money projections, I'll tell you what, you look at, again, I put the chart up here of how the distributions have paid. Other than one big, I'll call it check on the mark on the board, it was that April 2nd payout, the April 25th dividend that dropped dramatically down because of the drop off of the market. That was the only one that had the huge thing. But you take a look at using that one, even at its worst point, was about 53, 54 cents, back up to 63 cents. So a 10-cent difference between it, and you don't see a lot of bumps through it. So it's a fairly smooth road. This is why I say the current range of that 5,700 to 6,800, based off of 100% off of what you start off with. your numbers would definitely, if you took this at 50,000, you take a zero off, your top 570 to 680 per a month. Now remember, distributions are not guaranteed. They can change anytime you see it. As you see the line on here, every one of them is a little different. So you can't always, it's not guaranteed, you can't count onto it. But overall, QQI does give you a fairly potential steady income across the board so far. So portfolio, how would you use this? And I really put this in the real perspective, and I kind of let the cat out of the bag a little bit earlier, and that was QQI works best as an income component within a diversified portfolio. This is not a fund that you can say, set it, forget it, and I'm retired, and all your money's into this fund. I wouldn't use it this way. But the QQQI ETF is a great income generating component. It holds that NASDAQ exposure for some growth, but you really want an equity part of this. This is your income. You need a little bit of growth to help basically get you through those inflationary times. So your growth factors normally on a standard retirement package is probably between that 3 to 5% of growth. You want a fixed income that makes up for any of those adjustments according that QQI would give you. So you're looking at maybe bonds, T-bills for stability. And then on the alternative investments like REITs or commodities, gold, silver, you want to have that for just a market condition changes. So that's why I say QQQI is great in retirement funds. It goes great into the income section. It uses the income in small allocations. It's balanced with a broader market exposure. And realistically, it's lower historical drawdowns relative to QQQI during observed time frames. It's just a win-win situation. So taking advantage of these investment applications is this: exceptional yields. It's got a unique strategy with those covered calls and not 100%. So you're actually able to get some growth off of it. A little bit of downside protection. That tax efficiency is probably the biggest thing I put on the board up here. It's huge for that. And you have the ability to have flexible income with DRIP. So let me know what your thoughts are. How do you feel that you should use QQQI? Do you have it in your retirement fund? Do you have it at all in your fund? How are you using it? Are you dripping it? 50% drip, 100% drip, no drip at all. Personally, I have no drip on mine. I have a small portfolio with it into it, and I do use it accordingly. Let me know down in the comments below, and especially don't be afraid to hit that like button if you like what we're doing here.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments